Have you ever heard the term yield curve inversion in the stock market? It's often mentioned as a key signal for when investors should consider selling their stocks. But what does it really mean? In today's video, we'll explain what the yield curve is, why an inverted yield curve is considered a warning sign for the stock market, and what you need to know to stay ahead. Stay tuned. First, let's break down what long-term and short-term interest rates are. Interest rates are essentially the cost of borrowing money, and the duration of the loan affects the rate you'll pay. Short-term interest rates typically apply to bonds with maturities of up to 2 years. These rates are directly influenced by central banks like the U.S. Federal Reserve, which adjust benchmark rates to control inflation. Long-term interest rates, on the other hand, apply to loans with a duration of 10 years or more. These rates are driven more by market expectations about future economic conditions. If people believe the economy will grow, long-term rates tend to rise. If they expect a downturn, long-term rates typically fall. Let's talk about the difference between long-term and short-term rates, also known as the yield curve. Normally, long-term interest rates are higher than short-term rates because lenders expect greater compensation for locking up their money for a longer period. For example, if the short-term rate is 3% and the long-term rate is 5%, that's a normal yield curve. But sometimes the short-term rate becomes higher than the long-term rate, creating what's called an inverted yield curve. So why is an inverted yield curve considered a red flag? Historically, an inverted yield curve has often preceded economic recessions. Let's look at some past examples. The dot-com bubble of the early 2000s was preceded by a yield curve inversion. The global financial crisis of 2007 to 2008 also followed a yield curve inversion. More recently, the COVID-19 pandemic recession in 2020 was another instance where this economic signal appeared before the downturn. Why does this happen? It's simple. When short-term rates are high, it usually means the central bank is trying to combat inflation. Meanwhile, if long-term rates are low, it suggests that the market is anticipating a future economic slowdown. In such scenarios, investors tend to move their money into safer assets like cash or bonds, which causes the stock market to drop. Let's look at the current U.S. interest rate situation as of 2025. According to the latest data, the 10-year Treasury yield is around 4.60%. The federal funds rate is at 4.33%. The 2-year Treasury yield is approximately 4.28%. This shows that the yield curve has normalized, with long-term rates higher than short-term rates. This normalization suggests that the recession risks signaled by the previous yield curve inversion have lessened. However, it's crucial to continue monitoring these rates closely, as future changes in monetary policy could impact the market. Historically, an inverted yield curve has been followed by a recession within 6 to 24 months. However, more recent data suggests that this pattern is not always guaranteed. An inverted yield curve doesn't necessarily mean a recession will occur, which is why it's essential for investors to keep a close eye on economic indicators and not rely solely on historical patterns. While the U.S. economy is expected to continue growing in 2025, several risks remain. Tariff increases and immigration policies from the new administration could impact inflation and economic growth negatively. However, tax cuts and investment in productivity could offset these risks and promote economic growth. Investors should remain cautious and aware of these variables when planning their strategies. Should you sell your stocks during an inverted yield curve? It depends on your investment strategy. Short-term investors might consider selling to lock in profits before a potential downturn. Long-term investors, however, might hold on to their investments, especially if they've chosen strong companies. Dividend stocks, for example, can provide steady income regardless of market conditions. My key advice for long-term investors is to avoid getting caught up in short-term market fluctuations. Focus on identifying solid companies and understanding broader economic trends. Even if an inverted yield curve appears, it's important to remain calm and revisit your investment goals. Long-term strategies tend to outperform short-term panic reactions. Today, we've covered what an inverted yield curve is, why it's considered a warning sign, and how to approach your investments accordingly. The direction of the U.S. economy and Federal Reserve policies will play a significant role in shaping market trends. Did you find this information helpful? What are your thoughts on the current market? Don't forget to like, subscribe, and turn on notifications. See you in the next video with more valuable insights. Thank you.